Welcome to The Drilldown, in-depth answers to oilfield questions. I'm Richard Spears.
And I'm John Spears.
We are here on the very first week of 2021.
Our first working day, yes.
There are so many people who are so glad to get 2020 behind them. I don't care.
Count me in.
Yeah. So has anything actually changed? No, nothing's changed. Except you are 66.
I am, yes.
And you would be in group 2.
Here in Oklahoma, yes.
So that means you and your bride can go down and get
our vaccine if we can find a guy with a needle, right?
That's right. Well, we're going to just drive around western Oklahoma until we can get that. But while we're waiting to find a place where we can get a vaccine,
yes,
what we wanted to do today is set some expectations for the U.S. oil field for 2021.
That's right. I mean, we've all taken a little bit of a break, so this is a refresher.
Big break.
Regarding what we think is going to be happening in 2021. Yeah,
that's right. And usually at
both
a time
good and
like
bad.
this,
Yeah.
It's just what we think is going to happen.
Sure.
Usually for the last several years, this first podcast has always been our Nostradamus.
Right.
Episode where we predict what the event will be at the very end of the year. What will it be at the end of the year?
Yes.
Last year was such a disaster. We're just setting expectations.
There you go. Okay.
So let's, we don't have a specific number of expectations, but we do have a couple of questions at the end.
At the end, right. That
we'll be addressing over the next couple of weeks. But let's set some expectations at this point.
Fair enough.
You want to go first?
Sure. I'll start with, what everybody sort of top of mind, which is where are oil prices headed over the course of 2021. We entered the year with U.S. oil prices today trading about $47.50.
They are knocking on the door of 50. So do you think they get to 50?
I think, I think they will. Yes. I don't know that we're going to see them much beyond 50 over the course of the year. I think we'll be up and down, but I don't see them getting to $60 during 2021 at this point. The wild card here, I think, is the weakness of the U.S. dollar, because I believe
it is weak.
Yeah, right.
I mean, the euro-dollar exchange rate is 1.25 or something.
And there are times when a weak dollar contributes to a stronger oil price. It's not always the case, but I think right now the combination of events is working toward setting expectations that the dollar will continue to weaken relative to other foreign currencies. And as that happens, that's going to help push up the price of oil or help keep it higher. So that's kind of the wild card. That might be a strong enough factor to get you to maybe 60. But I just think in terms of supply and demand and those kind of fundamentals, I don't see it much beyond 50 over the course of the year.
There is a corollary to that, which is at what oil price. What's the oil price that the E&P companies are assuming?
Yes.
What are they spending towards right now? Because it's not that.
No. They would not be basing their budgets based on what they think spot prices are going to do. No, and
it's the olden days.
And because again, we have to remember that about 40 to 50% of the production for this coming year is already hedged at a price that's in the low 40s. So they're going to realize.
Wait, how much is hedged?
Somewhere around 40 to 50%.
So half of the oil,
roughly,
that's expected to come out of the ground this year,
right, has already been hedged at a price that's in the low 40s.
So that's welded in place.
That's in place, yeah. So operators aren't going to be able to spend as if it's $50 oil.
Because the banks, that money would have to come from outside.
Yeah, that's right.
And that outside is going to be closed for a while.
So that's going to then contribute to what I think is our second expectation. Is where is rig count going to end up by 12/31/2021? So
because it ended up the 2020, it's funny to say the word strong, given that it was the lowest ending rig count maybe ever.
Yes, right.
But it was trending up. So
I mean, low point in 2020 was in August, around 250 rigs. We ended up around 350 rigs. So
last time I checked, that's 100.
That's 100, and 40% recovery off the low. So. If this was Wall Street, we'd be in a bull market, right? But I think again, a lot of that bounce back is probably in place. I have a tough time, and our models tell me that 400 rigs is kind of the best we might expect come the end of 2021.
Is there any chance that your models are outdated?
Well, they struggle to reflect the new, what do we want to call it, paradigm, right?
Yeah, paradigm.
The fact that there's not outside money being put into the industry, right, in the form of either loans or equity. So that's always provided a lot of capital in years throughout our careers. And so when that's not there, that's a new element. That's an element that's missing that has been a driver of spending and rig count. And so we're, the models over time are adjusting to this reality, but I don't know that they fully captured that right now.
Because this, if I've got my history right, this is actually your 40th year,
something like that, in terms of
doing
this. The company has had an internal forecast of drilling activity for most of its history. Yes,
so
absolutely.
Do you remember how many times over that 40 years of adjusting that of that forecast that you've had to do a major revision in how you've gone about it?
Yeah, the modeling process has changed, and there's been about 3 major changes.
I think I remember one because for most of the 30 years, the U.S. anyway was a gas-focused market, and then in 2009, 2010, whoa, now we're an oil-focused market.
Yeah, and then there's been little tweaks inside.
Horizontal wells.
Well, the horizontal drilling thing was really changed. And that goes back 10, 15 years now. So there are times I tell folks that ask for lots of history so they can do forecasts. I say, yeah, it's great. Here's the history, but you have to understand that the industry isn't set up to and operate it the same as it did 10 years ago, 20 years ago, or 40 years ago. Right.
Okay, so one more knock-on thing to this, because we've done oil price, we did rig counts, and now it's oil production. What does that do to oil production out of the United States?
Right.
Because I was looking at, WPX later this week is going to be merged with Devon.
Right.
And I saw some analyst report today that WPX's oil output is up. Or finished, or it should be finishing up for 2020. Right. So it's roaring into the current year and into this merger.
No doubt both of those companies cut production, shut in production back in the weak months, Q2, early Q3, and have been bringing some wells back online. And then, of course, if they've been raising rig count, which I think they've both been doing, and fracking their uncompleted wells, that's going to help them. But I think as the industry as a whole, boy, certainly as we talk to the folks that we know out in the field, when they look at shale production, it's hard to get those guys excited about a turnaround. They see production from tight oil production going down and continuing to fall throughout the course of 2021. So I think there might be a chance at the tail end of the year that we might begin to see some of the U.S. Tight shale production numbers begin to rise a little bit. We get to around 400 rigs running and we frack those wells accordingly. I think we might get to the point where we can begin to bump the numbers up a little bit, but I think it's going to be a struggle to get there. Yeah.
The question is, or related to that, is that you've got a little bit of the wind in the sails with regard to oil production coming from the fact that I got a bunch of frac spreads working right now.
Yes.
Fracking wells that got drilled at some point in the last year or so.
Yep.
And so the frac activity is at a pace higher than rig activity would suggest.
Yes, absolutely. Right.
Now, the end of the year, it ended on a soft thing because most of us just don't want to start a new project the last couple of weeks of the year.
Right.
But we'll wake up here in January, and if there were 135 frac spreads working at the end of 2020, you'll see 5 go back to work every week.
Oh, for a while.
And so I'm thinking that frac spread activity, or some people call them frac fleets, I call them frac spreads, the whole thing is a fleet. I think it could hit 200. Now there were 450 available.
Right.
There are 500 if you count Canada. I mean, there's a lot of frac spreads out there a couple years ago.
We're not constrained on the supply side.
There is no supply constraint whatsoever. And here you've got, by the way, today as we do this, you've just seen the merger of One Stem into Liberty. So now I've got a bigger frac
Schlumberger, Liberty, back together.
Crammed together today. It gets all those former Schlumberger guys back together. But I think frac activity
Boy, that's a whole bunch of new ball caps, if you ask me.
What color do you get? It'll be red.
Anyway, your point was that.
But frac spread count could go up another 60. And that 60 could occur as we go through the spring and into the summer.
Right.
But once you get to that point, you begin to get the law of diminishing returns kicks in. I think it's law of diminishing returns. It may not be that. I kind of run out of targets. Because now I've drilled up my inventory.
Right. Rig count really then has to carry frac activity higher. Yeah.
So if your rig count maxes out at this 400-ish level, then 200 is stretching it.
What do you know, or what would you say about the productivity of those frac crews?
Well, I think it's this. There's a couple things that have been going on since for the last 6, 7, 8 months. Yeah. And that is the efficiency or effectiveness of all frac operations. Because what you're focusing on are multiple well pads, and I'm not talking 2 well pads. I'm talking 5 well pads, and up in the DJ Basin, we'll talk about the DJ Basin in a minute. 25, 30 well pads. Big operations. Yeah. So you set up once. 5, 6 weeks later, you tear down once. Right. But in the meantime, bring me more sand. Bring me more sand.
So the nature of the work has contributed to the higher productivity of these crews, whether you're measuring it in terms of what stages per day, I guess.
Stages per day is going to be it. If you look at the industry as a whole, about, say, a year and a half ago, it was really 5 stages a day.
Oh, really?
4 or 5 stages a day.
Per crew. So
per crew. You get a frac spread out there, 4 or 5 stages a day. For over the course of a month.
You understand, right?
Because there's going to be some days that they're moving. So one frac spread, 30 days times 5. That's the number. Yeah. But now if you look at how we've gone over the last 4 or 5 months, it's at 10 or 12.
10 stages per day.
Per active frac spread. Okay. So so a doubling of that efficiency.
Yes. Okay.
I'll bet that as we are, feeling our oats, I think you're going to be seeing these 15 stage a day metrics being hit fairly regularly. Right. Because focused attention, it really helps that the industry is not in chaos right now, but rather, pretty simple things. Right. Yeah. And then the other part is this: the era of the one well pad is done. Right. Yeah. And so we go to the most efficient form possible.
Sacrifice at the altar of efficiency, as they say.
It is. Yeah, yes. It is. And so, there's going to be one well pad drilled. Right. But for the majority of the work that's being done, I think when you go out to a well pad, you're going to see at least 3 and most frequently 5.
Well, so we've talked about a couple things, rigs and frac crews, and both we see activity growing. So the volume numbers pick up. If I'm a service firm, I'm seeing volume growth, but I don't think we're going to see much on the pricing recovery. So the pricing for those services, frac, drilling, whatnot, I look at the availability of equipment and maybe not so much people, but I just don't see that much pricing power in the hands of the service sector here in the U.S. during the course of 2020.
How does that compare with other times when you come off of a low?
Yeah,
because you've been tracking quarterly oil field inflation for quite a while, a dozen years.
Since 2008, and we've seen about 3 good cycles as a result of that.
and 5 really bad cycles. No, but right. So what is this
no, you have to wait. No, you have to. There's typically about 6 to 12 months before you begin to see some kind of a price improvement. So you come off of a low in rig activity, it's at least 12 months before you begin to see much noticeable improvement in pricing power, and it really only gets noticeable as you begin to see really pretty significant improvement off of a bottom. And while we say, well, there were 250 rigs running, John, you've seen 40% improvement already. sorry, that was a very sharp decline, and we're at a very, very low level of utilization. So I just don't see much happening on the pricing side until we get into the 2022 timeframe.
And that's drilling rigs. Is that also
I think it's almost across the board.
servicing?
Yeah, sadly, I think it's pretty much across the board at this stage.
But on the good news side, if you're looking at revenues of these oilfield service companies, revenues actually jolt up.
Yeah.
And probably, I'm going to stick my neck out here. We finished Q4 2020.
Yes.
Those earnings are going to be reported.
Yep.
Mid-January all the way through early March.
Right.
And I think that what you're going to see is on the U.S.-focused oilfield service company earnings reports that they did pretty well. On the revenue side. Maybe earnings didn't come to the bottom line.
Understand.
But on the revenue side, and you got to start with revenues.
Well, hold that thought, because that contributes to one of the questions I want to pose for later on. But I think you're right in that if nothing else, even if there's not much pricing power for service firms, I think that higher volumes allow companies to better absorb their fixed costs, and so I think all of that's contributing to improved margins. So
well, you see it in a firm like ours.
Yeah,
I mean, we kept everybody's still working. In fact, we're actually pretty busy right now.
I'm beginning to think of you as a fixed cost. Yeah, you don't move around very much, so that's qualifies. I think
a fixed cost can also be an anchor. I'm an anchor.
So you had said something about talking about the Bakken or the DJ Basin, right? Yeah.
And that's it. You see drilling activity being at worst stable and probably rising, frac activity rising.
In those areas.
Yeah, well, really across the nation.
Right.
But there's this big risk that you see in the DJ Basin, and you see a geologic or reservoir event going on in the Bakken.
Okay.
And so I think you've got a regulatory risk that's being fully seen in Colorado because of the state and the counties.
Right.
You see a federal thing going on because I probably have Mr. Biden as a president here pretty quick.
Yes.
So I think you're going to see Colorado as not a market like you have seen in years past.
Again, from what we're hearing from the field, operators are pretty concerned about the whole federal and in some states, state land issues. And it's interesting, as we have seen rig count. If you look at rig count at the end of the year compared to what it was in March, so before everything went to heck in a handbasket, right? Okay. In those western states like North Dakota and Colorado, rig count today stands 20 to 30% of what it was back in March.
Oh, so it's fallen 80%.
It's fallen, and it hasn't come back very much. Yeah.
Okay.
If you look at Texas and Oklahoma, rig count today is 40% of what it was at the high, right? So a noticeable improvement relative to...
So even Oklahoma.
Yeah, even Oklahoma was surprising.
Everybody's like redheaded stepchild.
Yeah, right. And then you think about the gas areas like Pennsylvania and Louisiana.
Louisiana's
right?
been
they're
awesome.
They're 80% of what they were back then. So there's been a drop, but it's been relatively minimal compared to what we've seen elsewhere. So, but clearly that leaves those Rocky Mountain states as I think areas that we just haven't seen the dollars come back into the field like we have in these other areas. So again, regulatory risk is I think a big factor in that performance. My
young friend, whose name I'm not going to say out loud, who's a reservoir engineer, is looking at the Bakken, and he says, they're running out of places of good rock to drill and produce from in the Bakken. And so here you've got a limit that's been reached.
Right.
Sure, you can drill more holes in the ground, but
every field does have its limits. What we're seeing happen in the Bakken is...
I got there first,
right? It's been pretty intensively drilled, and as a result, there's the low-hanging fruit has been taken away.
It's the low-hanging fruit and the not so low-hanging fruit.
Right, so now
I'm not climbing the rest of that tree. I'll wait till it falls.
We need some giraffes around here.
So we do.
Yeah, so I've got a couple of questions that
can I do one more thing?
Let's hear it. Okay.
So one of the reasons that the oil field got so darned inefficient early in 2020 and prior to that was because it was so busy in West Texas that you would get your load of sand, you'd pull out of the yard and pull right into a traffic jam.
Ah, okay, right.
And so you're trying to get out to the well site, you can't get there.
Sure. There's some real last mile logistical hurdles.
Huge problems.
Yeah.
And so the question would be, will there be traffic jams again in West Texas in 2021? And I think the answer is not yet. I think you've got this, activity's heating up.
Yes.
Traffic heats up.
Right.
People go back to work, but you've got another maybe year before it gets to
there's a critical point, right?
That's
where
right.
You can the highway can handle a lot of traffic, and then all of a sudden it's got one too many.
That's right. It happens slowly, and then all at
Anybody
once.
who's been in Houston knows the feeling, right?
Well, that's right. I can go right past the Galleria until I can't go past the Galleria.
Something like that.
All right. So the two big questions that we're going to address in the next few weeks.
Well, exactly. So the first one, in no particular order, the first one is, will investors once again care about the energy sector? Right.
Boy, I want to hear what we say about that.
Right. Yeah. So will rising commodity prices, as oil prices recover, as gas prices get better,
as dividend payments begin to appear,
right? Will those kind of things overcome investor apathy, if not outright hostility? Given the fact that we've got fossil fuel divestment programs out there among investors and so forth, that's going to be a real dynamic situation.
Fossil fuel divestment.
Exactly.
Yeah.
Right. Yeah.
How many Yale college students do you think we have listening to our podcast?
Lots and lots. If you mean Yale, Oklahoma, right?
Yeah. Well, we probably got some.
Yeah. There you go. So, but anyway, I think that's going to be an issue. We don't have a clear sign now, and that's something I think we and the industry, everyone in it, will be concerned about. So will investors begin to care more about the energy sector?
Which means, do we place our bets now?
Well, that would be one way to look at it, right?
Fully invested now. Right. But you have a really interesting question.
Yeah. So the other question,
part number two
is, will U.S. majors, so most of the, will U.S. majors follow their European counterparts and voluntarily give up market share to meet their climate change goals?
And just as an example, Royal Dutch Shell.
BP.
There's the word Dutch in it.
Right,
BP
Total and so forth.
B.
Many of those European-based majors have said over the next 10 to 15 years, we will cut production. Okay.
Yes, because we're going to build wind farms and solar farms and
some of it is a function of the investment it's going into renewables area, absolutely. And but we'll cut production, and doing all these things will get us to this net zero goal.
Because our energy output's going to be growing.
Well,
but the oil part of it,
right? Yes, exactly.
It's a promise that they may be able to deliver.
So you have a vision of a future, and you got to plan for something. For the most part, we haven't heard the majors based here in the U.S. say those same words.
Like Devon
well, a shale major,
right?
Or the Exxons and Chevrons of the world, right? So the question will be: Will we hear those kind of targets? Will those kind of plans be announced among their U.S. counterparts?
Will I quit growing oil? Will I actually give up oil output?
Yeah.
Will I make it drop?
Yes, absolutely.
And go do something.
So I like to think of it in terms of giving up market share, because we can understand the product. I mean, they're one and the same, but will they voluntarily give up market share on the production side as a part of this climate change initiative that the firms are undertaking?
Are we going to address this next week?
If I have some time to think about it and come up with something good, but soon and very soon, as the song says.
Well, look, we're if you're listening to us, to this podcast, well, you clearly made it into the new year, and congratulations for doing it. Don't give up hope. This is an industry that is very cyclic. It has not just the feel of a recovering industry, but the actual metrics of a recovering industry right now. Great time to find an entry point, and we're glad to be able to help you. And I think we're going to just be one less thing you have to worry about.
Hope so.
Anyway, thanks for listening. I'm Richard Spears.
And I'm John Spears.